So see, we are starting today's topic with turnover ratios. As in the previous session, we have discussed that there is Mr. X who wants to invest his money. And before investing the money into any of the company, Mr. X wants to know the performance of that company, or Mr. X wants to know whether the company is matching with the benchmark or the standards which are essential for an investor to decide regarding a particular investment. As yesterday's class we have discussed that 2:1 is the ideal current ratio. This is the standard, the benchmark. So it is very essential always for any company to achieve the standard, to achieve the benchmark, or yeah, always to achieve the ideal standards. If at all a company is doing that, there is very less risk involved in that particular investment target or in that company, right? So Mr. X today, like in previous class we have discussed and we were emphasizing on liquidity ratios. We wanted to see how the performance of Reliance company is in the area of liquidity. We checked how the Reliance company performed in that area. We even checked whether Reliance company is having some liquidity issues. See, a company should never have issues with its liquidity. It should have intact liquidity, which is very essential for its working capital requirements. That is to run its business activities smoothly on daily basis, to meet all its expenses. It requires short-term funds in the form of working capital. That's what we have ensured. And we've seen the performance of Reliance Jio in that particular area with the help of current ratio, quick ratio, and cash ratio. Today's agenda is to check the turnover or the efficiency of Reliance company in converting various current assets into cash. So today's class is all about checking the efficiency of Reliance company in converting its current assets like inventory, receivables, etc. in cash. That means how much time the Reliance company is taking to convert its inventory into cash, how much time Reliance company is taking to convert receivables into cash, how efficiently they are making the payments to their suppliers, okay, and how they are generating turnover with the usage of assets what they have. So all this we are going to check today, okay. So first one in that is inventory turnover, inventory turnover ratio. See, I will put some question in front of you. How much turnover you want from your company if you are running a company, or how much turnover you expect from a company in which you want to invest? I want an answer from you. Can you really tell me that particular standard level of inventory which every time you want from every time you desire? It's a very tough question because turnover is not something which is stable. It is something which fluctuates. If like turnover is not stable, the sales, so turnover means sales, the sales volume or the sales what company does is not stable. It changes, right? It changes every year. If it can be a mere coincidence if the turnover of the previous year is equal to turnover of the current year, but that is not the case always. As I said, it's a coincidence. So turnover is not stable, and I would put a question in front of you. How much maximum turnover you want from a company? Now your answer would be, so this is a strange question. How much ever maximum turnover I can make out from a company is what I always would be very happy with. Okay, that means We are not worried about the maximum sales. How much ever maximum sales a company makes, that much ever good for the company, because that much profits the company is going to make. More the sales, more the profits, right? Very high level of sales, more amount of profit they're going to make. So we are not worried about maximum sales. What we are worried about is the minimum level of sales. That means if company makes a turnover which is equivalent to their cost, then definitely you are not into profits. You may be at break even, but definitely you are not at profits. And if I say, if the cost what company is incurring is more than the revenue what it has generated, then definitely will say it is better to divest, that not invest. It is better to sell the stock of that company and get rid of that, or it is better to beware of such companies. If a company is not able to recover its cost with the turnover what it is making, then it is useless investment. It is a worthless investment, and we should be wary of such kind of investment. So one clear conclusion what you have got is a company should a very high turnover is always desirable. The maximum the turnover, the better it is, and turnover should at least be of such amount whereby the company is very comfortably able to recover all its costs, okay, and make some profit. And if the turnover is less than the cost, it is a worthless investment, right? So now we will see how much should be I said you right now, there is no standard for turnovers. There is no standard for profitability. There is no standard for greed. There is no standard for desire to earn money, etc. But we will try to see if certain level of turnover a company is generating, I'll not say sufficient, but at least that would be, satisfactory for the company, like in terms of recovery of cost and also generating some profits, right? So we will see what is that level of turnover which a company should minimum. I'm saying not about the maximum. I'm saying about that minimum level a company should always try to attain or achieve. Okay. So what is that minimum level of turnover a company should always try to attain is what we are going to see right now with the help of an example. So let's say this is Mr. X and he wants to, let's say I'll take the example of a small TV shop. Okay. TV showroom. So there is a TV showroom and this TV showroom has a capacity of 25 TV sets. So there are 25 TV sets which can find space in a particular TV showroom. That means this TV showroom has a maximum capacity of holding 25 TV sets. It is not only the shelves whatever they have, but the godown as well, whatever they have can only hold 25 TV sets all in all. That means at once on an average 25 TV sets is what they can hold. Okay. So this is quantity wise and this is amount wise. What I mean to say here, let's say company has sold 250 TV sets in a year. Okay. So if I ask you a question, how much the company has sold of its capacity? So for that, what we can do, total TV sets divided by on an average what inventory they are maintaining. So 10 times. That means company was or TV showroom was able to sell TV sets like to the extent of 10 times of their capacity. That means the capacity what they have is 25 TV sets. The capacity what they have is 25 TV sets at once. That means on an average they can only hold 25 TV sets at a time. So they sold 250 TV sets. That means they sold 10 times of their capacity, right? And if I say amount wise, let's say 250 TV sets is costing $100,000 and 25 TV sets is costing $10,000. So I will say this as COGS and I will say this as average inventory or stock. So what is my turnover ratio, inventory turnover ratio, stock turnover ratio here is basically the formula for inventory turnover ratio is COGS by average inventory. I'll write the formula also here. inventory turnover ratio is COGS by average stock, whereby COGS, I'll explain you about COGS, need not worry, is opening inventory plus purchases minus closing inventory, and average inventory or average stock, whatever you say, you can say, is equal to opening inventory or opening stock plus closing inventory or closing stock whole divided by 2. Okay, so I am saying that 25 TV sets is this. That means opening and closing all together, if I do an average, my average stock is 25 TV sets in my example, and the cost what I'm incurring for the entire TV sets I sold is $100,000. That means for 250 TV sets what I sold, my cost what I incurred is $100,000. That is COGS. All right, and the average stock what I'm maintaining every time, that is 25 TV sets, costs me $10,000. Right now, if I see my stock turnover ratio is 10 times, that means I have sold 10 times of my capacity. Right now, what is the importance of this 10 times? We will again see here with the help of one more formula, that is formula number 2, stock conversion period. So if I can sell 10 times of my capacity, whether it is good or bad, we will see right now. So stock conversion period is nothing but how many days it takes for you to convert your inventory into cash or stock into cash. Okay. Or how much time it takes for you to liquidate your inventory. Formula is 365 days in a year, whole divided by stock turnover ratio. So 365 by 10 is 36.5 days, or you say if you take 360 round figure, it is 36 days. So it is taking 36 days for you, okay, to convert your 25 TV sets into cash. Okay. Okay. And in that way, so first 36 days, 25 TV sets are converted into cash. Next 36 days, 25 TV sets again are converted into cash. Next 36 days, again 25 TV sets are converted into cash. This 36, if I write 10 times, it becomes 360. Okay. Okay. And in this 360 days, I'm converting how many TV sets into cash? Please tell me. Is it right or wrong?
Yes.
Yeah. So it is taking 360 days for me to convert my 250 TV sets into cash. Okay. And how many times I am selling my 25 TV sets? 10 times. Okay. That 10 times if I sell, it makes it to 250 TV sets, right? So now my question to you is, if my, so ideal stock turnover ratio is always 8 to 10. Whenever you are going to invest in a company, you check its stock turnover ratio. It should always be between 8 to 10. And if it is greater, it is even better. Let's say if my stock turnover ratio is 12, turnover ratio is 12, if it is 360 by 12, so 30 days it will take for me to convert my inventory into cash. So I will be converting my inventory much sooner into cash if my stock turnover ratio is high. That means higher the stock turnover ratio, less the number of days it takes for you to convert your inventory into cash. The higher the ratio, the lesser the number of days. The lesser the ratio, the more number of days. That means if we can see here, if the turnover ratio, if the stock turnover ratio is 12, it is taking 30 days for me to convert my inventory into cash. If the stock turnover ratio is 10 days, it is taking 36 days for me to convert my inventory into cash. That is very clear that higher the ratio, the better it is. Okay. So I'll write a point here. But ideal is 8 to 10 that you can, that is acceptable level. Okay. That is what it is accepted in the industries, and the standards say after a thorough research 8 to 10 is the ideal turnover ratio, ideal stock turnover ratio. Okay, so the higher the, that means this much minimum. Okay, minimum this much times you should sell in a year. If you are selling lesser number of times, let's say if your turnover ratio is 5, it will take very long number, more number of days for you to convert your inventory into cash. 360 by 5. 360 by 5 is how much? How many days? Hello?
72.
72 days it is taking for you to convert your 25 TV sets into cash. Do you think this is a pace at which a business should sell its inventory? No, it's a very slow paced business. So worthless. So the higher the turnover ratio, the better it is. Okay. So now all of you just have a look through these ratios. If you want to make some note, you can make. Immediately I'll move forward. Fast, huh? Tell me, I'll scroll the screen down. Okay. Now let's go ahead. Let's go ahead with the next ratio now. So stock turnover ratio is done. Now we are discussing about receivables turnover ratio. And simultaneously we'll put payables turnover ratio as well here. So receivables turnover ratio. Okay. What do you mean by this receivable turnover ratio? What does it tell? It shows the relationship. So let me write on the formula. Receivable turnover ratio, data turnover ratio formula is net credit sales divided by average receivables. Net credit sales by average receivables, and the formula for payables turnover ratio is net credit purchases whole divided by average payables. Receivables are nothing but the customers to whom we have sold the goods on credit basis. Payables are nothing but the suppliers from whom we have purchased the goods on credit basis. From receivables, we are supposed to collect money. To payables, we are supposed to make the payments. Okay. So now what are we going to see here? Please understand. Net credit sales by average receivables. So what does it show? It shows the relationship between net credit sales and average receivables. And what does it show? It shows the relationship between net credit purchase and average payables. Okay. So now what does this particular statement called? It shows the relationship between net credit sales and average receivables and net credit purchase and average payables mean. We will understand right now. Let's say like we have made a credit sale of $100,000 in this particular year, and whenever we are sending our collection team to collect the money from our customers, okay, we have an in-house department who like collects the money from the customers. In today's time, customers won't come and pay, so we have to approach them. Okay, at many a times we have to do that, we have to take such pain. So sometimes my collection boy is like, when he's going for collection, he's getting $8,000. Sometimes he's getting $10,000. Sometimes he's getting $12,000. Sometimes he's getting $6,000. Sometimes he's getting $15,000. Okay. So in that way, he is collecting the money and he is trying to collect 100,000 from customers. So in this way, when I did an average, average is nothing but sum of the observations by number of observations. When I did the average, excuse me, just a second. Yeah. So like on an average, when I did the average, it comes around $10,000. So now What is my receivables turnover ratio or debtors turnover ratio? 10 times. Now again I have to check. So same thing. I will replicate here, but first let me let me make you to understand this concept even more properly. Whether this 10 times is good or bad. So for that we will again go with one more formula, that is debt collection period. So debt collection period formula is 365 days in a year, naturally, whole divided by debtors turnover ratio or receivables turnover ratio. So 365 days, let's say we are having 360 days in a year, by 10 gives you 36.5 days. That means it takes 36.5 days for my collection boy to collect some amount. Okay, let's say on an average I have got 10,000, right? See, my collection team is going and collecting the amount in this way. Let's say we have done an average. So every 36.5 days on an average we are collecting 10,000. Okay, in this way we are collecting $100,000. Okay, we are collecting $100,000 in a year. See, 10 times we are collecting the money. Every time we are collecting how much? 10,000. Okay. So how it goes? 36.5 days. In 36.5 days, I'm collecting $10,000. Next 36.5 days, I'll be collecting $10,000 on an average. See, this is very near, like near about 10,000. Again, 36.5 days, I'll be collecting more 10,000. In this way, if I add up all this, I'll be getting 365. Or if I multiply with 10, I'll be getting 365. That means in 10 times, I'm collecting my money from my customers on an average of $10,000, right? And in this way, in 365 days, I'm collecting my entire amount. Now, is it good or bad? We will discuss right now. See, if it is 10 times, it takes 36.5 days to collect the money. If it is 12 times, it will take 30 days to just recover or collect my entire money from my customers. Okay. And one more thing I would like to say you, if you are doing a business or if you are doing analysis of another business, the standards of receivables, in the sense any business should never breach the credit terms. Okay, any business or any customer should never breach the credit terms. And if you are performing a business activity or you are owning a company or if you are doing analysis of any company in which you are interested, they should never give a credit of more than 30 to 36 days to their customers. That is the standard. Okay, the benchmark. If at all you are giving a credit of more than, that means if you are giving a time of more than 30 to 36 days to make the payment to your customers, you will face lot of problems in your business. Now what kind of problems you can face? Problem number one, the more the delay in the collection of money, the more liquidity problems or issues you may face. That means if you get your money on time, you can put that money into your business. You can meet your business needs. You can make the payment to your suppliers promptly and get the supplies from them. Okay. And if you can maintain all the expenses on time, because every business is well prepared for 1 month's expenditure in advance. But beyond a month, it is very tough for businesses to survive if they are struggling to collect their money. That means now you'll be having a question in your mind, sir, they can take loans, they can take overdraft facility. Yes, but that doesn't come free of cost. There is cost for everything in this world. If they take overdraft facility, they have to pay interest and overdraft facility charges. If they take short-term loans, they have to pay interest for that, and that's going to reduce their profits. So why all this mismanagement? Are we doing a business are we doing a business efficiently? No, we are doing a business inefficiently in this case, because there is no management here. There is a mismanagement. Why? We are not very particular with respect to the standards which we need to follow when it comes to collection of money from customers. Because if you are giving or extending credit period more than 36 days or 45 days, 50 days, 60 days, you imagine the condition of the business if 60 days credit is given to some customer for making the payments. right? Now you go to DMart or any other business, do they even wait for a single day? No, immediately, instantly, in that particular 1 second, you have to make the payment to them when you're on the counter. That's it, finish. Either you don't have money, you just bring your credit card and you make the payments. That's what that facility they're giving you. So ideal is 30 to 36 days. If Reliance company in which you're going to invest is giving 60, 80, 90 or 100 days, you shouldn't invest in that company. Now you'll be asking me a question. No, sir, there are many businesses which are giving 3 months, 4 months credit. See, if they can afford, they can do, but that is against the standards. That's what I clearly want to say you. Okay. So 30 to 36 days and 10 to 12 is the ideal receivable turnover ratio. Okay. So please go through this concept. If you have any doubts in your mind, you can ask me. I'll go for the payables turnover ratio then. You ask me, I'll scroll it down. Okay. Okay. Give me a second. I'll have some water and come. Just give me a second.
Done, sir.
Yeah, give me a second. I'm drinking some water. Just a second. Okay. So coming to payables turnover ratio now. We have already seen that it shows the relationship between net credit purchases and the average payables. Now we will understand this ratio in more detail. So we have payables turnover ratio. I gave you the formula: net credit purchases whole divided by average payables. So same kind of concept is applicable. Let's say I have my business has made a purchase of $100,000, and on an average the payables what we maintain is $10,000. That means we are making payments to the payables, and when we did the average, on an average $10,000 we are paying always. So my ratio comes out to be 10 times. Is it good or bad? We'll know with the help of this formula. Debt payment period. What does this formula say? 365 days in a year whole divided by payables turnover ratio. So 365 by 10, that means it takes 36.5 days for us to make the payment to our suppliers, and the ideal is always 30 to 36.5 days. Why? Because when we are running our business, we don't want to give our customers more time than 30 to 36.5 days. How come we can expect our suppliers to give the same time? I understand it is a very good practice to collect the money as soon as possible and delay the payments as long as possible, but not always. If you don't make prompt payments to your payables or your suppliers, if you don't make the payments on time, they will be reluctant to supply goods on time to you. You will lose goodwill in the market. You will not have good rapport with your suppliers, and you cannot afford to have a bad relationship with your suppliers. Okay, because if they stop the supply, or if their syndicate, or if their cartel, whatever you want, you can say, if they stop the supply, then what's your case? So it is a serious payables mismanagement if you are delaying the payments for very long periods. Okay, very long periods. See, 1 or 2 days is understood fact. 3 or 4 days or some buffer days is okay when there's a holiday, when there is a government holiday or weekend or whatever, some reason, but not like it should be an honest reason, but not a dishonest reason to delay the payment, right? So always, you will earn very good reviews, and you will be in the good books of your supplier if you make them payments on time. That is what you should ensure. So 10 to 12 is ideal payables turnover ratio, and 30 to 36.5 days is good number of days in which you need to make the payments to your suppliers, and don't trouble them. Okay, so please go to this ratio. We'll go for more to ratios in this category.
Done.
Yeah. Next comes fixed assets turnover ratio and total assets turnover ratio. So the formula for this is net sales divided by total fixed assets. Okay, or if at all you have only 1 year's figure, that means only single year's figure, this is the case, or else average fixed assets. That means opening figure plus closing figure divided by 2. In this case, the formula is net sales whole divided by total assets, or average total assets when you have 2 years figures. Okay. What does this particular formula tells? Anyone can answer this question. What is the use of this formula? I'm asking the question to everyone. Can unmute your mic and tell me the answers. What is your opinion, or what is the interpretation you make out from this ratio? Fast. Come on, give me the answer. Don't be so dumb.
That how fast that our fixed assets would give the profit.
I'm not getting the answer. Again, can you repeat?
Like how fast our fixed assets would give us the profits.
No, it's not about how fast.
How much?
See, the interpretation can be in such a way that if you put $1 of your investment in fixed assets, how many dollars of revenue is generated? That means $1 investment in fixed assets is generating how many dollars of revenue? That is what we want to know. Okay. So let's say, I'll give you an example here. So there are two shops here. One is a 1000 SFT shop, and one is a bigger shop, a big one, a 10,000 SFT shop. So this particular shop, what we are seeing is a old shop, okay, can hold a limited capacity of inventory. It's a very big shop, newly opened showroom. You know, today's concepts are different. Some 15 years back, the concepts were different. Today, these people are having some trendy kind of peppy kind of interior and very appealing kind of, shop in a very good location. This is having a very good, this is having a high regard in the society or in the area in which this is established, because it's an old one catering to various customers since long time. This is a new one, okay, trying to make its mark. So here the total assets, total fixed assets, what you have, see, you know what is fixed assets. Okay, fixed assets are the ones which have tangibility. I mean to say physical substance. Tangible means it has physical substance in it. So furniture, building, land, all these are the fixed assets here. It also has the same thing: furniture, building, land. Okay, and the total assets valuation here is, you know, $1 million. That is 10 lakh. Let me give you the figures in Indian terms. 10 lakhs. Here they have spent 50 lakhs. Okay, because it's a very big area. And here this is the fixed assets investment what you have done, and the turnover what you are generating here is 50 lakhs, that is $5 million. Okay, here 5 million is your investment, and 10 million is what you're going to generate. Okay, so 1 crore is your revenue. So fixed assets are having a valuation of 50 lakhs and the turnover is 1 crore. Okay, now if I put this in the ratio, my ratio happens to be net sales by average total assets or total fixed assets. The same thing goes here, 1 crore by 50 lakhs. Here it is 5 upon 1. That means $1 of investment in fixed assets is giving me $5 of revenue. Here it is 2 upon 1. $1 of investment in my fixed assets is giving me $2 of revenue. Now you tell me which is a better one, which business is a better one, where it is more efficient utilization of resources is happening. Come on, tell me now, please. The first one or second one?
First one.
That's what, first one. It is a better one, right? Now,
Yes.
yeah. we'll go for the next ratio, that is total assets turnover ratio, net sales by average total assets. So, in total assets, we would take the current assets and non-current assets both. Okay, that is, we will take current assets and tangible assets, right? Instead of taking just only fixed assets, I'm taking fixed assets as well as current assets. Okay, that means all the total assets, and the interpretation part is same. Net sales by average net sales by total assets or average total assets. This is 1000 SFT shop. This is 10,000 SFT shop. Net sales here happens to be 50 lakhs, and total assets, whatever you have, is to the tune of 10 lakhs. Okay, we'll keep it same 10 lakhs. Okay, and here 1 crore and here 50 lakhs. So it is 5 upon 1. It is 2 upon 1. Here $1 investment in total assets is giving $5 of revenue. And here $1 investment in total assets is giving $2 of revenue. So this is what you understand, which is more efficiently utilized aspect. In the case of 1000 SFT shop, the efficient utilization of resources can be seen. With $1 what we are investing in our assets, we are trying to generate $5 of revenue. That is 5 times of our investment in our total assets, right? So this is what we have covered today in all this, in the area of turnover ratios, 5 formulas, and apart from that, more 3 supporting formulas we have covered. So 8 formulas we have covered today. Okay, then we will start with profitability ratio. Okay, let us take that. I have 15 more minutes, so why not wind up that? So we can do some questions tomorrow. So now comes the 3 ratios what I'm going to explain to you, profitability ratios. So I'll send you a question tomorrow in the morning. You try to answer that and show and send me the screenshot. Okay, it is a homework for you. I'll send you a question tomorrow as a homework. I want the answer for that. Okay, so gross profit ratio, operating profit ratio, net profit ratio. So these are the 3 profitability ratios I am considering. Why I'm considering these 3 profitability ratios? I want to invest in a profit making company. First of all, that is very sure and clear stance I have, because not only it's me, I'm not a special case here. Everyone in the world would like to invest in a company which is profitable. Now, what is that optimum level of profit what a company should make? There is no such level in the world. So if I ask you a question, you're investing in a company and what returns you're expecting, you will not be, you cannot answer that question. Okay, then see, my data was, my statement was, you are investing in XYZ company. What returns you want out of that investment, or how much returns you're expecting from that company? You go blank. Okay, you don't speak anything. Why? Because what should be an answer for that? Very strange question. Why? When it comes to profits, you want as much profits as you can. That's what. It's dil mange more. So, but again, if I put some kind of figures, 10%, then you say, yeah, to some extent I'm satisfied, but if I get more than this, I would be more satisfied. And that's the right answer from an investor's perspective. It's not like you're greedy. You want every penny what you have spent, you want returns out of that. Whatever a single penny you are going to spend, okay, you want output from that, or you want returns out of that. For every single penny spent, you want some kind of returns, right? That is what you have a motive of. So 10% 15, then if you say, okay, 10% is a good return for me, then I say, why not 15%? Then you say, yeah, I'll try to adjust. And I say, why not 20%? So it's a never ending situation. No one can be satisfied with levels of profit. Now then question comes, then sir, how I shall satisfy my profit needs? The answer to this question is there is no absolute measure of profitability. Profitability is a relative measure. That means if previous year your profits were 10% and this year the profits are 18%, definitely you are more satisfied this year. Why? Because you have earned more 8% profits than the previous year. That means if I tell you gross profit ratio, what's the formula for gross profit ratio? Gross profit by net sales into 100. What's the formula for operating profit ratio? Operating profit by net sales into 100. What's the profit for net profit ratio? Net profit by net sales into 100. Okay, and we will put a small income statement here. It is sales, okay, $100 less COGS, $60, gross profit, $40. Then you have operating, administration and selling expenses. Let's say other incomes, you have other incomes, $10, and then you have operating, administration and selling expenses of $10. I'll say operating, administration and selling expenses. Okay, then if I remove all the operating, administration and selling expenses, I'll just not put other incomes here. Let me not put it here. If I take this, then 40 minus this is $30. This is called operating profit. Okay, or it is also called as PBIT, profit before interest and tax. Then I add other incomes, that is non-operating nature incomes, $10. Then I subtract non-operating nature expenses, other expenses like interest paid. Okay, so if I nullify this two, I get $30. That is my PBT, profit before tax. Then I remove tax. Okay, $10, then I get $20 as my PAT, okay, or net profit. So what is happening in every phase or every stage? This is the profit which I earn from my core activities. Core activity. What do you mean by core activity? See, every business, okay, is known to perform certain activity. If I tell you about Maruti Suzuki, you will say, sir, it's a manufacturing company. What kind of manufacturing? Automobile manufacturing. If I tell you Sun Pharma, sir, it's a pharmaceutical company. If I tell you Red Bus, sir, it's a startup. If I say you Orange Bus, sir, it's a service. It's in service industry. It gives transportation services. Okay, like they run buses for commute, isn't it? So from city to city, they connect cities and the customers travel. So it's from the travel industry, right? So every business, the four businesses, whatever I have mentioned right now, is performing some activity which is their core activity. From their core activity, prime activity, whatever profits they are making is gross profit, because very simple, I have not deducted all the expenses till this level. I have only deducted certain expenses which are direct expenses with respect to the business activity what I'm performing. What is a direct expense here? Let's say if it is manufacturing company, so I may have certain expenses like direct material, direct wages, factory expenses, etc. Okay, see, there are various formats. This format what I have written in front of you is a format related to a company which is not a manufacturing company. Let's say it's into trading. Okay, for manufacturing company you have to find out COGM, cost of goods manufactured, not COGS, cost of goods sold, cost of goods manufactured. So there are a lot of differences, but let us generalize the concept. So these are all my these all are my direct expenses. So when I remove all these direct expenses from sales, I get the profit. Resultant profit is gross profit. This is the first stage of getting some profit. Okay, because if in this stage you get losses, then it is useless to go forward. Okay, so this is the first stage where I have tasted some success or profit, and that is my gross profit. If my company's gross profit was 8% previous year and this year it is 10%, I'm happy. Finished. And then comes the operating profit, which is nothing but the profit which I have earned, okay, from my business operations or from my operations. So from gross profit, I'm just refining my profits now. I'm filtering it. I'm removing all this operating, administration and selling expenses, and I get the operating profit or the operating income, I can say. This is my income which I have earned from my business operations. That means after removing all my expense of core activity and all my expense of administration. Okay, that is direct expenses and indirect expenses or overheads I have removed. Okay, then finally comes my net profit, which is my final profit after removing even more expenses which are not operating nature expenses, which are non-operating expenses. See, first we removed direct expenses related to our prime activity. Then we removed all the administration and selling expenses. Then we are removing all the expenses which are not of operating nature, which has nothing to do with our business operations like finance expenses, interest paid, etc. Then the final profit which I get is net profit. Okay, I have written the formulas in front of you. I'm running short of battery. Anytime it will be out. Okay, so I'll try to explain this. So if my operating profit in my example, it is like, $30. So 30 divided by 100 is, okay, no, let's not put this. My operating profit formula I have put in front of you, that is PBIT or operating profit by net sales into 100. And if previous year my operating profit was 8% and this year it is 12%, I'll be more happy. And net profit also, if previous year it was 10% and this year it is 15%, I'll be more happy. Okay, so that is the measure. It's a relative measure, not an absolute measure, right? So all these ratios what I've mentioned today, please go through that. Tomorrow we'll do a question and I'll send you a homework question in tomorrow morning. You should solve that. Okay, all these ratios. Thank you. Thank you, all of you.
Thank you.
Thank you.